All right, then let's start from what we missing last week. Okay, this week we can talk about two topics today, right? First, we need to finish consolidated financial statements, and what we need to address again is just about what the slides on the screen up here. If you can recall what we did last week, we're talking about the level of investment, right? When we talk about the level of investment, let's start with when we start letting invest in debt security, we start invest in equity securities, right? When you start to invest in debt security, you classify them as held to maturity securities, trading security, or available for sale securities. We move to equity securities. We classify by the percentage of ownership. If you start with a small ownership first, you have to classify them as well. Do we hold this investment for trading or available for sales? All right. When you move your degree of investment up to significant influence levels, you have associate company. Right, and then when you increase your ownership into the power to control level, you can control the company. Your relationship between your company and the investee company, we call parent and subsidiary relationship. You start to do consolidated financial statements. All right. So normally, when you go to the company listed in the stock market, you normally see parent and subsidiary. We have like a group company. So that's why this slide just summarize you on what's going on after what we learned so far. When we talk about consolidated financial statement, if you have subsidiary only, you are required to do both statements. First, separated financial statements. Second, consolidated financial statement, which is wrapped. Right? For consolidated financial statement, it means what? You just try to add all the financial statement from your subsidiary into the parents, make it a pack, and of course you need to eliminate intercompany transactions or intercompany balance. That's why we call consolidated financial statement. If you move to the right side here for separated financial statement, in terms of investment, you learn about two methods. Cost method and equity method, right? For cost method, what that's supposed to mean? Investment remain at cost. Your revenue turn to be dividend income. If for equity method, investment account changed by the equity of the investee. If the investee got profit, you got share profit, and of course, it's bump up your investment. If the investee got loss, you got to share loss with them as well. Like let's say associate company get lost this year. You invest with them 30%. They lost 100. You have to share loss with them for about 30. You got the share of loss right there as an expense. All right. But once the associate company pay dividend, when they pay dividend, the equity of the associate company drop because they pay out of retained earnings. That's why when the equity of company drop, your investment drop as well. That's how we call the equity method. And of course, for separated financial statement by accounting standard, they allow you to choose two methods to prepare the separated financial statement. Some company can choose to use cost method for their investment. And the other company can use equity method for their investment. How we know that? We're going to know that from first, you read to the notes to financial statement. The note's going to say, well, our company decided to use cost method for the investment. Or you can spot on the income statement straight away. For income statement, if you pick cost method, what's going to be in there? Dividend income. But if you pick equity method, what's going to be reported in there? Share of the net income from associate company. You can spot right away from the financial statements. All right. So for separated, if the company choose different method, of course, it's going to be hard for you to compare net income in terms of separated. Even they are in the same industry. That's why when you perform financial statement analysis, you got to be careful. All right, because the company are allowed to pick either one of them. Be careful. That's why I would suggest you when you analyze financial statement, move to your consolidated. Because some company turn to be only holding company. Right? If you are holding company, like I give you example before GMM. GMM, they run entertainment bits. GMM are the holding company, is a holding company. They have Exact, they have A-Time Media to work for them. They have lots of company to work for them. So you want to measure the firm performance for the group, of course, you better turn to the consolidated. And of course, when you look at full consolidated financial statement, if the company, the group company got more than the subsidiary, if they got both subsidiary and associate, subsidiary we do consolidation. But for associate company in consolidated financial statement, they are required to use equity method. All right, so you're going to see share of net income in here. If they got joint venture in their group company, for joint ventures, they are required to use equity method as well. All right, so that's why this slide, this picture here, try to summarize on what you can expect to see on the financial statements. So now it's time to think about, well, if we have to link all the four statements together, just like some people asked me last week about how do we trace all the number from income statement to statement of change capital equity to the statement of financial positions. I would say I'm going to show you from this statement there. Go to financial statement.
Where? On YouTube. Yeah. Pet. Oh, do you have this URL? No, you just copy the URL of NBA 600. Every class ever we have is uploaded there. Oh, really? I was waiting for this update. Yeah, but I bug him every day to make him updates so I can do it at.
It's for the Siam Cement Group. Okay. In terms of consolidations, just like what we learned before, in the financial statement positions, asset equal to liability plus equity, no question asked for that. All right. But when you're looking at the components of equity, hold on, let me try to show like this much better. You have three parts of the equity part. You have capital part. You have retained earning part. And you have this part, which is other components of shareholder equity. All right, that's why when you got all the structures right here, registers, issues and paid capitals, and this is what you just learned from last week, NCI, non-controlling interest. All right, of course, this is the shareholder equity part. We got like 4 components for consolidated financial statement. If you're looking at the income statement, just like you learned from Dr. Pinsuri, right? We got net income, but net income as a group belong to 2 persons. 1% is from parent shareholders, then the other one is for NCI, because this is for the group company. That's why the profit of the group, we got two partners to think about. And when you're looking at OCI part, this is what you learned before. Mark to market for investment for available for sales. Today you're going to learn a little bit more on translation gain loss right here, which is from accounting standard number 21. For SCG, in this case, they have subsidiary in foreign country, not only in Thailand. That's why when you want to do consolidated financial statement, you need to translate financial statement. Let's say they got company in Vietnam, currency is dong. You need to convert from dong into Thai baht and then do consolidation. That's why we got gain loss from translation, and of course, it's not going to reflect on the income statement. It will reflect on OCI part. All right, this is what you're going to learn today for accounting standard 21 right here. And if you take a look at this part for income statement here, the end income will go to the statement of shareholders' equity. This is for year 2017. All right, if you recognize this number 67 here, profit and loss for the year as a starting point for statement of comprehensive income and adjust with OCI. That's what I told you before. So from this OCI things, move right here. If you're looking at the statement of change in shareholder equity, all right, I'm going to show you like this. I highly suggest focus on one year. If you're looking at this slide, we got the same. First, here, equity part, the share capital part, which is the yellow part. All right, retained earning part. Forget my colors. Right here. And OCI part. Right here. And NCI part. All the numbers, which is what you're looking at right here. Let's see, if you recall this 301, if you look right here, they're the same 301, which is the detail is down here. And you can provide the reconciliations from the beginning of the period to the end of the period. And from the profit and loss, if you take a look, we got right here, P&L, right? If you can recall, for PL, 55 and 12, 55 and 12, because this is belong to the parents, this is belong to NCI. Add all together, you got 67. 67, same number. So make sure you know where the numbers go when you read the financial statement. From the income statement, before you jump into the equity part, we got statement of change in shareholder equity to taking care of everything from the three panels here. And if you want to take a look what in other components, if you spot right here, oh, we got lost for about 20 millions, where it's coming from, you may need to looking at here. 29,110 is right here. 29,110. And 29,110 is right here. Total OCI, and this is the detail. So in your papers, when you do last week, make sure you know how to trace all the numbers. All right, so it can help you when you analyze the firm performance. Okay, hopefully I take you through to make sure like you get used to the real financial statement. Otherwise, you're gonna see, oh, it's from the textbook, it's nothing to me. But in the real world, this is the way it is where they link together. From the income statement, the profit and loss and OCI move to the statement of change in shareholder equity. That's why it's quite important for you to looking at what's caused equity change. And then the bottom line, this is the balance at the end of the year. All of this move to this panel right here. That's how you can see all the details. All right, hopefully you got a big picture first. So today we're going to move on a little bit on what is this?
No.
Different in translating. Is that the same for transaction? Somebody will say, well, it's not. All right, so I'm going to go back to this slide first. Right here, on slide number 43. The change in foreign currencies. This accounting standard apply to foreign currency transaction and foreign currency financial statements.
Something big happened. No.
Yes.
Mm-hmm.
Same chapter from last week. I didn't move that much.
Big impact.
All right. You guys got this one?
Negative impact. He declared socialism.
It's on the same chapters. Somebody get lost.
The stock price.
No, don't worry about stock price. It's a good thing. We
Do
should
you
all go
remember
back to
this chapter
socialism.
when we do all? Sorry, when we do all the things right here. Yeah, still in the same chapter. Just move back a little bit on page 43. Thank you. Yeah, you guys got this? Good. Okay. Well, this accounting standard talking about two things. First, we're talking about foreign currency transaction. And the other one, they're talking about foreign currency translation. It's in foreign currency financial statements. All right. First, I'm going to talking about foreign currency transaction first because it's the easiest one. All right. So let's suppose you are import-export company. All right. You are a company in Thailand. You want to import something from USA. Of course, the invoice is going to come to you in US dollars, isn't it? All right. But you have to record everything in Thai baht because financial statement in here in Thailand, we need to prepare in Thai baht. So of course, you need to translate you need to transform US dollar into Thai baht for recording. What exchange rate you're going to use then? Buy or sell? You know exchange rate, right? We have buying, selling, and TT. What you're going to use? Sales or buy? Because if you want to record, let's say you buy something from US, if you go with perpetual inventory system. You debit inventory, you credit AP, isn't it? Let's say $1 equal to the exchange rate for buying 30, for selling 32. What you're gonna use 30 or 32 to convert $1? 30 or 32? 32, why? Why we need to pick up selling rate? Hmm? You buy something from US. Okay, let's say we have buy, we have sell, code 30, 32, like this. When you got something from US, you need to debit inventory. Let's say $1, credit AP for $1, and of course you need to transform them from dollars to Thai baht. What exchange rate you're gonna use? 30 or 32? Somebody say, oh, it's gonna be 32. Why? You got, when you want to pay off them, what you gonna do? You go to the bank to buy US dollars to pay for them. The bank gonna sell dollars to you. That's why we go for selling rate. Alright? But let's say this is on, let's suppose this is on October the 1st. Let's suppose we have to pay them on October 30. Exchange rate change, buying turn to be 33, selling turn to be 35. What's gonna happen? You're gonna use this one, right? When you pay. You go to the bank, you credit cash. Let's suppose you transform like this. It's gonna be 32, 32. So you go to the bank you want to buy $1 from them, you pay for 35. And debit AP out for how much? 32. You got gain or loss in this case? Loss for 3 baht. Very easy, right? If everything settled in 1 year, let's suppose. But what if it's not? Alright, but if it's not, it's time to think about, well, how do we report AP on the statement of financial positions? Okay, try the new transaction. Buy and sell. On December 20, 30, 32. December 31st is gonna be 31, 34, 36, like this. And on January 15, turn to be 29, 30. This is exchange rate across the period that we need to look at. On December 20, this is what you buy. Right? Debit inventory for 32, credit AP for 32. You use this exchange rate, right? To record. It costs $1. At the year end, on December 31st, you still got $1 AP. But it's time to think about how do we report them. If we report them at 32, it means your statement financial position did not reflect the current exchange rate. That's why it's time to adjust the balance of AP, isn't it? So you credit AP up to 4. Add them together, you're gonna get 36, isn't it? Right? From 32, if you want to pay today, how much you gonna pay? You need to pay 36. Is that right? That's why you need to bump the AP up to from 32 to 36 and 4. You got loss in this case for 4. But loss, we're going to say unrealized FX loss. Because you cannot recognize. Because you didn't pay for real. On January 15, it's time to pay. The credit term is due. Debit AP, how much? Liability you got right now? 36, right? From 32 plus 4, now you got 36. So when you clear out the AP, you got 36. But what happened? Exchange rate you're going to use, you go to the bank, I want to buy $1. Okay, you pay only 30 baht, you get $1. Credit cash out for 30. Gain or loss in this case? Gain. But now it's time to, it's the realized FX gain. 4, 6. That's the way it is. This is for transaction exposures. That's why if you're looking at the other slide, what exposure when you got foreign exchange is transaction exposures. Think about if we got AR, not AP, we got receivable. If you got receivable, what exchange rate you're going to use? Buy or sell? You're going to use buy. Because if you got $1 back from AR, you get to go to the bank to sell $1, bank going to buy from you, isn't it? Alright? And it's going to be the other way around. So what happened in this case? The number on the statement of financial position keep moving by exchange rate. Some company can get gain, somebody can get loss. Of course, both of them report on the income statement. That's why you need to learn about derivatives, like forward contract, to do some hedging. Otherwise, if the financial statement moving like this, it's going to be hard for you to analyze the real performance. That's why you need to buy forward contract, because if you get lost in the underlying asset like this or liability like this, the forward going to be gain to offset. If you got gain on underlying asset, the forward going to be loss to be offset. You need to buy the right position. That's why as a management, you got to make sure you buy the right forward contract to match with your term performance. Okay? That's the way it is for transaction exposures. Alright? But the difficult part is going to be translation exposures, which is the other one that I'm going to talk about. If the company has foreign entity or has subsidiary in foreign country, just like I mentioned to you before, if the company got, the parents got subsidiary in Vietnam, everything is in dong, right? Subsidiary in Vietnam report everything in dong. What you gonna do then? You cannot do Thai baht plus dong to do consolidation. Now it's time to translate them. Translate them to what? Translate them from baht, from dong to baht. All right. So now it's time to think about the two technical terms: functional currency and presentation currencies. When we talk about functional currency, it's quite tricky here. That's what I'm going to warn you when you analyze. If you're looking at definitions, the functional currency is a currency that the company operate. It doesn't mean company locate. Different. Alright? Not like if you operate in Vietnam, your functional may not be dong. Same thing, if your company, even you locate in Thailand, functional currency may not be Thai baht. For example, PTTEP. They operate everything in dollars because they deal with the oil and gas. The operation functions currency will be US dollars. Alright, even though they're located in Thailand, in Bangkok, PTTEP. because they do exploration, the oil and gas. So the oil and gas price depends on US dollars. That's why functional currency not gonna be like location. I need to correct you guys all the time. Even for undergraduate students, I always emphasize like this. Functional is not by location. It's about operation. Clear? Good. Now it's time to think about presentation currency. Presentation currency is the currency that you want to report. If you want to report in Thai baht, you need to convert functional into presentation. And of course, now it's time to think about, well, how do we translate them? Okay, back to basic. Subsidiary is in Vietnam. Operational currency is Dong. All right, our subsidiary is over there. We are the parents. We need to translate from Dong to Baht. Got it? Okay, from Dong to Baht in this case, think about the component of financial statement. You got asset equal to liability plus equity. You got revenue, you got the expense. Then you need to translate asset, liabilities, revenue, and the expense. All right, before you consolidation. And use equity as a plugging in like that. So for asset and liabilities, you're going to learn about the technical term. We have spot rate, historical rate, current rate. All right, spot rate is the rate, exchange rate on the day the transactions happen. It is spot rate. But once the time passed by, that spot rate turned to be historical rate. Okay, current rate is the rate on the statement of financial position. So if we get back to this scenario, let's suppose this is a spot rate on December 20. On December 31st, when we prepare the financial statement, this is turned to be current rate. All right. This spot rate now transformed to be historical rate. All right. So just this is the way we call by technical term. Now when we want to translate, break it down, you have asset, liability, revenue, and the expense. On the days of transaction, on the day of statement of financial position, which is December 31st, what you get? Asset from the spot rate or historical rate turn to be current rate. So use at the rate of year end. Liability, same thing. Transform with the same exchange rate. But for revenue and the expense, based on accounting standard number 21, what they say is they should use historical rate. Expense as well. Let's do like this. Let's suppose this one is 30, this turn to be historical can be in any day because you make revenue every day, isn't it? Right? So it means can be 29, can be 30, can be 31, can be 32, can be 33. Expense as well. Depends on when the transactions happen. Alright? So once they convert like this and do consolidation, the difference between the amount after we convert, we call FX translation gain loss. The difference between among the amount that we just translate turn to be FX translation gain loss. I just introduce you to get to know how we got this number or where they're coming from. And if we know the nature is happen like this, gain loss like this, where should we locate them? In the income statement or in OCI? If we report in the income statement, people will say it's not fair. It's not from their operating performance. That's why they're plugging in this number in OCI part. Alright, so you know OCI item for two items now. First item is unrealized gain loss from AFS security, available for sale security. Second OCI that you learned today is gain or loss from FX translation, not transaction. Transaction report directly to income statement. Only translation is right here. Alright, if your company is unlucky, invest in the country that the currency after you convert is lost, that's from the company judgment, not from the company operation. Right? Based on management judgment, not from the operation. So make sure when you analyze the income statement or OCI, you understand the logical behind. Okay? That's for FX number 21. I don't want to touch things much. I don't want to train you to translate because it takes a while. 3 hours at least when I taught undergraduate students. So you guys just get to know where the number from, where are they reported, and how you're going to use it. That's important when you analyze statement. So if you get back to right here, see, for SCG, Siam Cement Group, available for sales gain not that much. But what happened from exchange rate? Actually, if you take a look, unit is in 1,000 baht. So what happened? Not 8 million. 8,000 millions loss compared from last year. All right. So if your company like from Japan invest in Thailand, of course, when you do consolidation, we don't do the same thing. Translate and recognize in here, record in here. Okay. Hopefully you got where the numbers go. Okay, right here. Some companies are unlucky. Go to the country that which is we call hyperinflationary economies. Let's suppose you go to Zimbabwe. High inflation. Before you translate gain or loss, you need to translate by adjust the functional currency first. Adjust by use inflation index first to make sure the number is stable. So we have a little bit more step to do before you convert to the presentation from functional currency. You need to adjust the number first by inflation index. And after you adjust by inflation index, you got the right number, then you translate them. Okay? So hopefully you guys don't go into that kind of country. Otherwise it's gonna be too tough to do. Right? That's why back a couple years ago, we worked with PTT before. I know people in PTT actually. When they work with PTT EP explorations, before that they record everything in Thai baht. But after they identify, oh, my functional currency now is US dollars, they have to do two accounting information system. The first system run in Thai baht. The second system run in US dollars. Alright, in Thai baht for like internal purpose. US dollars, they run it on US dollar and then on the closing date, they transform from US into Thai baht and then PTT take it for consolidation. Like that. Another system is for tax purpose. They got three systems. It's a new job back then, but now they get used to it now for PTT. Alright. So if you work with shipping company, a logistic company, what may be your functional currency? For logistic, it's overseas all the time, right? You are shipped a long way. So you can be like, oh, maybe and my operation is based on the oil. So your functional maybe US dollars. For the logistic company like that. Carrier, I'm not going to say logistic, I should say carrier, right? Because their main operation is based on US dollars. So the implication, if you identify a wrong functional currency, you can think about the consequence for the exchange rate. Another example is interesting when I study in UK. Subsidiary parent is in USA. Subsidiary is in UK. You would say like, well, if subsidiary is in UK, their functional should be pound, right? But this subsidiary is a holding company. Okay, the case is quite complex in this one. Subsidiary is holding company, and they hold company in European country. So the functional will be euro. So accountant over there got to working on both statement. First statement in euro and statement in pound. Think about people who do consolidated in US, what they're gonna do. They need to convert from euro first, convert from pound to euro, and then from euro into US, and then can do consolidation by this accounting standard. That's why the first job is identify functional currency, and then you know where to go. Okay? So I think we're done for the FX for now. Let's move back a little bit on consolidation issues. For consolidation issue, I've categorized into two categories. All right. First, we call change in ownership. Go back to the same chapter, but on slide number 36. I'm going to talk for the first one first, for change in ownership. Oh, last week we're talking about upstream, downstream, you recall that, right? Okay, you're working on the exercise already, so it should be fine. For change in ownership, let's do like this. This is on January 1st. This is on December 31st. Let's suppose you acquire the company on April the 1st. This is when you acquire, because nobody works on New Year. All right? So you wait for 3 months and then you acquire the company. You acquire company for 90% at this point. Now it's time to think about the profit that we need to take a look. This is the profit for the whole year. Let's say 120. This is the profit for the whole year. Once you acquire on April the 1st, which is 9 months, and the 3 months. What that's supposed to mean? On the day you acquire, you have the right to share the profit only 9 months, isn't it? Right? So if you break it down into 90 and 30, so what that's supposed to mean? 90 here break into 2 parts. 81 belong to you, right? 90% of 90. And 9 here belong to NCI. Is that right? To be fair. How do we call this? We call pre-acquisitions income. So in the financial statement, if they report like this, it means in that particular year, you have some part of income that you cannot own. Pre-acquisition income. All right, I'm not going to teach you how do we do it, but tell you the meaning of that. All right, the first case is that you acquire the company during the year. Second case that we need to take a look is the series of the stock purchase. So like this. On January 1st, or maybe no need to, actually can be on February 14, okay, Valentine's Day. You buy for like 10% of the common stock. I'm gonna ask you like, well, should we treat as trading or available for sales? This is from ASIF 9, it's gonna be fair value to PL. This is fair value to OCI, right? Well, let's see, on March 31st, end of quarter 1, how do we report this investment? Mark to market, right? We need to mark to market, and we have unrealized gain loss. Go to PL or OCI up to the time of the investment. Clear for that? You have only small portions of your investment. Now, let's say you go to now on April the 4th, you still carry at 10%. And then you decide, well, I want to gain significant influence now. You buy for another 20%. Now your ownership turn to be 30% in that particular company. The relationship between you and your that company turn to be associate company. And what accounting treatment apply? Cost or equity method. So in quarter 2, June 30, what should we do for this investment? Do we need to mark to market? No, right? Because now you own them as associate company. We don't need to mark to market. But what happened if you pick up the cost method? You need to recognize dividend income. But if you change your mind, well, I don't want to do cost method, I'm going to go with equity, what happened? You need to record profit sharing for 2 months, right? So now you got to be like equity method, got income from associate company. This is degree of ownership, move on. All right? Let's say on August 6th, for example, you still carry 30%, then you buy more for another 35%, turn to be 75%. What is the implication in this case? Now turn to be subsidiary. Cost or equity? You record equity before, right? So now your amount is going to blow up with investment on equity method plus another investment at cost. Now it's mixed, isn't it? It's mixed now. All right. At the end of quarter 3, on September 30, what you gonna do with this? Console. Because turn to be subsidiary, right? You got console with separate. What that's supposed to mean? If you choose equity method, what's gonna happen? 30% which is carry, take equity already. Another 35, take another 2 months, right? You need to take equity from 6 to September 30. Isn't that right? For this 35. And also 30 right here. This means you take both into your investment. Because now you got profit sharing for 65% from today to today. But before that, you take only 30%. It's going to be a big mess when you take equity method. That's why when you increase your share ownership, the important part is make sure you separate profit across time. Take with different percentage all the time. All right. What about consolidation? Separate, you done. You use equity method. Make sure they take equity with the right portion. All right. But what about consolidation? Do we have a problem with that? Quite straightforward, right? Your investment balance, 75%. Can do consolidation. NCI gonna be 25%. All right. The tricky part will be this one. If you have goodwill, take the good. Yes.
I'm not sure with that. The 75% is from 30 plus 35.
30 plus 35. Oh, sorry, 65. Sorry.
Okay.
Yes, 65. 65%. 65%. That's it. All right. So you have NCI for 35%. The tricky part is going to be from here. So at this point, you can recognize goodwill or gain on bargaining purchase if you can recall, right? When you do consolidation, because this is a step one, you take a control. Okay, I'm gonna draw this line. What if from September 30 to December 31st? At this point, you have 65%. Okay, we're gonna have two scenarios. And you consolidation, you got goodwill. On December 31st, you buy more, plus another 20% of ownership. Now turn to be 85%. Alright, 65 still carry into this point, and you buy another 20, and you buy higher than fair value. Do we have to recognize the goodwill? The answer is no. The goodwill can recognize one time, once you take the control. Once you take the control, you got the goodwill at once. Alright? The difference when you buy more than or above fair value, we call gain or loss in that case. Just like they're gonna affect your equity section, not gonna be goodwill. Just like you have a change in shareholder equity part, just like the last exercise I gave you last week, the homework. They have an exchange in ownership. Just like you buy from this part, you buy from NCI. So it means NCI transfer their owner to you. That's it. No gain or loss record in the income statement, no goodwill. They're gonna affect your equity section straight away. The difference between the purchase amount and the number you get. Well, so then if nothing happened from now, what's going on? And December 31st, you can do consolidation. Clear? I make a little bit more tricky. Let's say on December 15, the management of your company say, hey, I sell for 40%. Sell it out. Change ownership again. Drop to 45. What's going to happen in this case? You make the sales. You need to recalculate the book value on that day, on December 15. Once you sell, you can create gain or loss from sale of your investment. And of course, your investment balance drop, isn't it? Got a new cost. In this case. And of course, 45% associate, is it, right? Choose cost or equity. And still carry on into December 31st. Then you know how to do it later. I just teach you the concept because this one I teach for 3 hours for accounting students when they change ownership. But you guys just 5 minutes, that's enough. No rush, otherwise you come to my undergraduate class, it's fine. Alright? It's fine. This chapter is quite fun. It's after the midterm for final exam, this class, for advanced accounting students. Alright, so if we move like this, change ownership all the time, of course, the way we present the financial statement is different. You guys are management in the future, investors got to know how we come up with all this number. One thing to remember, goodwill record at once you get the control. Once you lose the control, you can recognize gain or loss. Because now you lose the control, change share ownership. But if you lose ownership but don't lose the control, for example, change this scenario into this scenario. From December the 1st, you got 85%. But on December 15, you decide to sell for only 15%. You still got 60% remain, right? Oh, 70, sorry. It's a long day for me. 70%. What happened here? You still got the control, but you just lost your ownership. Do we have gain or loss? Once you sell to your NCI, if you sell above book value, gain or loss, you're going to say, I got gain. right? But in fact, the accounting side said you not got gain. You just like you swap share from your part into NCI part. We report this as a change in shareholder equity. That's it. Cannot record gain or loss. But if you lost the control, then you can record. But if you still control, you just like exchange the shareholdership. All right? Just to let you get to know what's going on for the chain of ownership. Another thing that you need to know is what if, let's say, subsidiary, they used to have common stock at 100. Let's say 10 shares. Every share is 10 baht. Back then, you hold for 70 shares. You hold 70%. Let's suppose 1 year later, they issue a new share for about 50 shares. Now common stock turned to be 150 shares. So it means what? The subsidiary issued a new share. Question will be, you normally hold 70 shares to reflect 70% of ownership, right? If you want to hold 70% of this 150, how many shares you need to buy? You need to buy another 35 to get 105, right? So you remain the same proportion. What if you say, no, I'm not gonna buy? Shareholdership drop. What I'm asking is, you lost the control. 70 over 150, what happened? Lost control. Now change from subsidiary into associate. What if you say, Ajahn, I want to buy. I want to buy 35 shares exactly because I want to remain the same ownership. I say, fine, it's your right to buy. But you buy above par. You buy not going to be at 10, you buy at 12. What happened? You buy more than the par. It's time to think, well, we get gain or loss. We want to remain the same ownership. We cannot recognize any gain or loss in this case. It's going to affect to your equity. Even though you sell, you buy above par or under par, doesn't matter. You need to recalculate again. All right? So you're going to see some company in equity section. They have different accounts name report in equity section, like change in ownership of subsidiary. That's happened like this sometimes. When the subsidiary issue new share and you buy or you don't buy, or you buy but you buy above par, you buy under par, or sometimes I don't want to buy at 35, I want to buy only 10. So your ownership turned to be 80 over 150. You still subsidiary, you don't lose control, but you change your ownership portion. All right. My accounting student asked me, Ajahn, do we have to learn all these things? I said, well, can you stop management to do all these transactions? If you think you can stop them, you don't need to learn. But if you think you cannot stop them, of course, you got to learn where the effect goes. Accounting students learn more than you guys. You guys just know the effect like this. Accounting students need to learn how to prepare to get the numbers. All right. Otherwise, you go with a small company, no group company. you're gonna be alright. Get away from all those things. You don't need to worry about that. Okay. What else then? Additional share, the ownership share. Well, now turn to the other topic. Indirect ownership. What that's supposed to mean? Parent, subsidiary, let's say they hold 90% and 80%. Parent hold subsidiary hold the other company. We call parent, son, and grandson. You want to see great grandson? You cannot stop them. You want a great and great? Yes. It's a chain like this. That's how they do this group company. What that's supposed to mean? C belong to B, B belong to A belong to S, S belong to P. Do consolidation for the whole chain. Multi-level, or can it be P whole S, S whole A, whole B, whole C, and whole like this. Parent, son, grandson, that is connected as well. The way we do consolidation is what? 90%, 30%, 50%, and 40%. This is 20, this is 30. Can you identify NCI for me, please, from this diagram? So outside hold this 70%, right? 30, 70, hold C. Got it? Look, this Mr. A. 50, 20, this gonna be 30 is outsider. Look at this guy. 40, 30, what is this? 30% is outsider. And this outsider is 10. Is that right? NCI? P can control S. Can S control B? Yes or no? No. B just associate company of S. Alright. Can S control A? Yes, right? Actually, almost yes, but it just hit the line. You need to prove again. S cannot control C. What if that's happened for PTT group? It's fun. I love consolidation. It's like a puzzle. It's like a spider web. But when you were a kid, this is what we did. Yeah. It's like reciprocal ownership. But now SEC not allowed to do like this. Cannot hold back. They stop this transaction. But back in the old day when it was an auditor, this is what happened to me. When they do consolidation, they hold each other. Like this, we call mutual profit. Yes, the profit share to each other, like that. All right, just to let you know, this is the structure of consolidation. Okay, that's how we call like connecting company. They connect to each other, just like that. Okay. Now let's do the other one. On this slide, I talked about that already, so you can go back and read by yourself. I think we done for the consolidations. Now let's go for this sections. I need to bring this thing up first. Investment property. Skip earning per share and share equity first. We're going to talk about that later. We move to investment property, which is the next sections. Let's move on right here. Okay. Skip that part first. We come back later.
I went too far.
Too far.
Alright, I'll find it from
Right here. Not far.
perfect.
Go.
Okay. Thank you. Okay, got it.
Just move one chapter. That's it. Just move only one chapter. Just right here.
Together what?
Yeah, right here. What is investment property? What do you think? The property that I invest.
Something that you purchase
What is investment property?
that is on for purpose.
The property for your investment. Is that PPE? Yes, it's the PPE. But it's a PPE with different purpose. The purpose of this PPE is for earning of something else. Right? Because normally when you use PPE, property, plant, equipment, when you learn with the Chandrim series, it's just for operation. You use property, plant, and equipment like building or machine to get revenue, right? But if you buy another property, for example, I'm a manufacturing company. I produce shoes. So my PPE, property, plant, equipment, is be like my land and build factory on and buy the machine coming in. You learn that, oh, I got the land, and build up land improvement, got the building, I have depreciation, fine. And you can do revaluation as well, right? As I told you, right, about revaluations of PPE, right? To revalue. Well, I produce the shoe, I make a lot of money, then I have some extra money. I buy another land and build up the building, but not for my factory, but it's for like to let people come in and rent it. What is my purpose of my investment now? I'm not gonna get the revenue from main operation. I get it from in the form of rent revenue. So your purpose changed from main operation to earn something else. So that land and that building we call investment property. So after you identify this is my investment property, now it's time to think about accounting treatment. For accounting treatment here, we have two models to think about. First, we call cost model. The second called fair value model. Once you decide you got the investment property, the way you report, you need to report in separate line from the PPE. Don't mess with the PPE because you have different purpose. That's why we have to report everything separate. Look at the first model, cost model. Cost model is just like what you did for PPE. When you have cost model, what you're going to do next? Well, calculate for depreciation. Second, impairment, if they got one. You know the word impairment, right? I explained to you before, right? So you need to make sure you calculate accumulated depreciation and check for impairment. That's for cost model. The question is, can we revalue that? Can we revalue? Yes, everything you can do the same, just like what you did for PPE. In the peak cost model. What if you say, no, this is my investment property. I should treat them just like I did for my investment. So for investment, you need to mark to market, right? Because you want to speculate. It means what? You choose the second method, fair value model. Alright? So now, you think when you got two companies for you to choose, one company use cost model for IP, another company use fair value model for IP. Which one the profit will be fluctuate? Fair value model. Alright, so you turn to the next page to summarize what I just said. If you look at the cost model, everything is the same, just like what you did for PPE. Alright? And underline here, disclose fair value of investment property too. Even you avoid to mark to the fair, but you have to disclose the fair. Alright? Even you choose cost and you say, oh, I don't need to worry about fair value, but in fact no, because you must disclose the fair value too. On the other hand, you move to the right hand side. You choose fair value model. For the fair value model, what's happened? Everything to be report at fair. Alright? Everything is report at fair and underline on net income, not revaluation. You just like you mark to market. Some people say, well, maybe my company should use fair value because my asset price should go up. But in fact, maybe not. Think about the building. Think about the machine whatsoever. If you use fair value, sometimes the value is dropped. You can suffer from loss and you cannot avoid loss. Alright, so everything report affect to net income like that. But if you choose fair value model, what happens? You need to continue to use it until you dispose them or reclassify them. Alright? So most companies very conservative, go for cost model. Otherwise, if they choose fair, they're going to use fair forever. Right? Because accounting stats say, wow, this is what you do. And the important thing is when you use fair, the last bullet, you need to tell people too where you got the fair value from, how you get the fair value, and also give reconciliation between beginning balance and ending balance. Alright? So if you are management, which one you prefer? Cost or fair? Depends on what?
Depends on situation. Depends on situation.
Situation, what situation you're gonna use cost, what situation you're gonna use fair. Think carefully before the answers. They got pros and cons in both methods.
Or sometimes that lower profit, but at the same time, lower profit means lower tax.
When you say what? Fair value or cost? Cost. You gain benefit from depreciation. That's it. And what happened to the value of the asset?
But
Re-
the cons of cost model is that you don't reflect the fair value of
And what is the
the asset is actually lower than
what is the disadvantage of not report the fair value?
to have like less asset.
Less asset. And then what else can be there? If you got less asset, what happened to your ROA? Half. Return on asset low. Right? You are management, you're gonna learn this. People say, well, your company report quite old investment property value because you don't mark to market, right? Your ROA is high. But analysts say, well, I can get fair value from the note to purchase statements and can adjust it to get the right ROA. Can you do that? Let's suppose on the financial position statements, we have IP report 10 baht. Fair value say 15 baht. So if you find out we got the value like this, how you can adjust the number to adjust the statement? You just simply add asset up for 5 and what is on the other side. You say I got gain, and where's the gain report? Where's the gain report? It looks like accounting standard, you apply cost. On your analysis, you apply fair value. So you just use the fair value model in your analysis. Basically, asset go up for 5. Revenue, which is gain, go up at 5, right? Net income go at 5. Retained earnings also go up at 5. It's gonna be nominal effect like this, isn't it? So you are smarter than people who would prepare to adjust by yourself. If you think it's not right to report cost model, I choose the number fair value from the notes and adjust it to get what you want. Now turn to fair value model. Do you think it's good or bad to choose this? Asset is quite updated. The value is quite updated. Right? Is there any advantage or disadvantage when we choose fair value?
Is it more costly to use this method because you have to get the reliable measurement of the land and the UPT?
If you think it's costly, so everything measured at fair will be costly. You are right. That's why for a small company, we not allow them to use fair value. But for listed company or public accountability entity, you are welcome to use fair value model. All right, you are right. Well, it's costly. All right, but in term of that's when you talk about costly, you talk in term like you are management. You don't want to use the fair value. But some people say like this. Listen carefully. Well, I don't think I need to hire somebody to revalue the asset for me, because every time when I do the insurance, just like you build up the building, you need to do insurance for your building. The insurance company have to appraise your value of the building. Can we use that value as a fair value? What you think? It's fun when it comes to the practice. Use the amount of the insurance. You know what I mean, right? That's fair. We use the amount that we insure because they need to revalue up. Then, if let's suppose the building is destroyed, this is the money that we got from insurance. Did that make sense? Some engineer told me like this. You need to spend money on appraisal company. Use this. The value on insurance policy. Because there's an insurance amount. What do you think? If you can answer, I'll let you go. Go for a break, actually, not for home.
But it's not the price, like market price.
But it's just like you say, it's not the price, but if we go for appraisal, what do they give? They just charge me a lot of money. Why we need to pay for that? Cost benefits not worth. That's what they told me when I asked them like, oh, I want to hire some people to revalue the asset of July. They say, no, you don't need to pay that big money. You just go for the insurance company, insurance policy. We got the insurance amount. Can we use that? What's that? Reliable? Well, if you think insurance company is professional company, I'm gonna take all your answer and then answer him. Let's say I asked my MBA student, this is what they told me. What do you think? What do you think? Should I agree to them?
They may measure is lower than the actual. Can they do that? Like
But you mean like the price will be understated, right?
Or
The
overstated.
That's the amount that they have to cover if something happens to the building.
That's my argument to them as well, right? I think it's professional, but they need to concern with risk, right? So the amount that they insure may be different from the real fair value. Because the definitions of fair value is like if we want to sell the asset or liquidate the asset, I don't think we can sell at this price. We can sell more than that. It's worth for me if I want to pay for appraisal company to get the right value. And if I can tell them like this, you think how often can we do revaluation like this? It means if I choose fair value, I need to do every year. Right? They may suspect like I have sister or brother who work in appraisal company. Isn't it? That's the tricky part when it comes to in practice. When you use fair value model like this. Well, another slide before I let you go. Next slide. When you want to transfer from IP to inventory or PPE. Let's say I changed my mind. I don't think this building will be for rental. I want to transform building to my main office to use for operation. What did they say for cost model in your slide? If you use cost model, you cannot change the carrying amount because it's already at cost, right? You transfer all that. But if you use fair value model, you transfer with fair value. This means what? Gain or loss that you just mark to market recognize already. You transfer, and the property fair value is considered to be a new cost of that property and start to doing depreciation afterwards. Clear for that? So let's say, for example, very easy, like when we build investment property 100, it's marked to market to 80. All right. On the day that you present the financial statement, you mark to market, already marked at fair. But 2 months later, you want to transfer from IP to PPE. Now you have to think about after 2 months, the price change or not. If it's significant change, you need to revalue again to recognize gain or loss for over 2 months. Let's suppose from 80, it's go to 90. The 90 is going to be the new price for the PPE and use that price, which is 90 for depreciating. Okay? That's the way it is when you transfer. So basically, think about compare what we did for last 2 weeks. When you transfer investment category, let's say I want to transfer from trading to available for sales. We transfer at fair, right? Same thing for here. You want to transfer category from some things to the other thing. We also transfer at fair, all right? To avoid your brain gonna be dead because of accounting. I try to catch the concept for you. When you want to transfer across this category, you transfer across that fair. All right? Now I think it's time for a break. When we come back, we're gonna go for trouble debt restructurings. Okay? Yep, take a break.